This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. The CFA Society of Switzerland. They wanted to do an interview. I obliged. What follows right now are their questions and my answers. The first question, how did you first become interested in investing and trend following in particular? Tough question. As time goes on, I somewhat forget the exact moment, but I want to say summer 1994, I picked up a magazine. It said the financial world's top 100 paid on Wall Street. And number 35 or number 37, something like that, was a late 30-something-year-old accountant from Virginia who had just made around $40 million for the year 1993. His name was Jerry Parker. He was a turtle. From that moment, from that little snippet in Financial World, summer 1994, and it couldn't have been no more than a paragraph, and it said that basically he did not use fundamentals. Once I saw that, okay, game on. Here's a guy from my state, Virginia, who had no financial background. I mean, he was a CPA, so he had that background, but he wasn't a trading wizard or a trading legend, and he learned from someone else. Game on. Once I saw that, no fundamentals, learned from someone else, Jerry Parker, a turtle trader, that was it. That was all I needed. Once I learned that, it was going down the rabbit hole to find all the other people that were trading in similar ways. That would be the John Henrys, the Bill Dunns. I later learned the David Harding out of London, the Martin Luke out of London. All these people, the Larry Heights of the world. All these people that were practicing trend following. That was it. Once I saw that turtle article, boom. Number 2, given that most of our readers are CFA charter holders or candidates, some of them might have a preference towards a long-term fundamental stock analysis approach. What would you say to those who might be skeptical about the benefits of trend following? First thing I would say is, have they been living under a rock? Really? It's 2017. Momentum exists. There are two forms of momentum, time series momentum and cross-sectional momentum. Time series is trend following. Cross-sectional is relative strength. The academic work that exists regarding momentum, the debate's over. If the CFA candidates don't know now about trend following, they're irresponsible. Where's their due diligence? Where's the teacher's due diligence? Why is the CFA not instructing their candidates about something that is not only academically proven, the trading results for trend following go back decades. Not only that, the research takes trend following literally back hundreds of years. AQR out of Chicago, they've done a research report on trend following going back 100 years to show performance. CFM out of Paris, Jean-Philippe Bouchot, they have a research report going back 200 years. ISAM out of New York, Larry Heights' firm, going back 800 years to show trend following performance. I have no sympathy for CFA charter holders that are skeptical. Now, if they simply choose to go value, and that's their choice, well, of course, there's a fabulous foundation that value investing works. But the idea that you could be skeptical of trend following in 2017, that's malpractice, really and truly. Number 3, in your podcast, you have talked to the leading experts in several fields, including economics, investing, and psychology. Do these people share any characteristics or qualities that might have contributed to their success? They don't accept the party line. They like to research. They dig deep. They don't just trust institutions because institutions say something. If the institutions all believe in the efficient market hypothesis, but evidence dictates that there are severe holes in the efficient market hypothesis, they don't let academic risk or career risk hold them back from criticizing, hold them back from the new research. The idea is to think like a physicist. Let the data win. That's another common characteristic, data. Instead of starting with some political ideology and then finding data to back up that political ideology, find the data and then maybe you will find an ideology. I think another big characteristic, open-minded. All of these brilliant people that I've had on my show, Nobel Prize winners, Robert Aumann out of Israel, 80 years old, professor, game theory. He breaks it down to the simple. I mean, here's a guy who was essentially right there at the very beginning at helping to figure out the game theory that kept us all alive during the 60s, during the Cold War. A lot of his work is right there at that root. You listen to him today, he sounds like a kid. He's just a big kid trying to figure out a puzzle. And that might be the last characteristic. I mean, there's a ton more characteristics, but puzzles. People that like to dig, they dig because it's a puzzle. They can't stop. Ed Seykota talks about this, the great trader, Ed Seykota. He can't stop. He must figure out the puzzle. He might not necessarily even know why he's driven to do it, but he must figure that puzzle out. On the other hand, if you're very good at following rules and following orders, puzzles don't mean anything. Take the desk job, wake up in 50 years, and it's all over. Number 4, do many of your guests have any daily rituals or habits that the rest of us could try to emulate? Do you have any daily routines that have helped you in your career and life in general? Skeptical. We mentioned earlier that the CFA candidates might be skeptical of trend following. I'm not saying skepticism is bad. I'm saying skepticism in the face of overwhelming evidence is ludicrous. I'm saying skepticism in the face of not you having done the work to find out what's out there, that's on you. But the daily routine, wake up skeptical. When you're fed information, ask, probe, dig, beat up that information. Find out who the messenger is. What's the agenda? What's the propaganda? Who is really winning? Whose side is the messenger on? Your side? Someone else's side? Don't trust. It's the classic line from Reagan about Gorbachev. Trust, but verify. I will absolutely trust new people, new ideas, but then I will verify. Big picture, it really helps to have a system, an approach that you can follow no matter what. If this happens, you're prepared. If that happens, you're prepared. You're going down a path where you know surprises are not going to kill you because you've set things in motion well in advance to deal with that unexpected, to deal with all that uncertainty. Now, if you go through life not thinking through, just trusting what the academic institutions, corporate institutions, the government, if you just trust those groups and you don't question and you're not skeptical, you will get something you don't want when it's all over. Number 5, you have interviewed a number of behavioral economists on your podcast. It appears that most investment professionals have some kind of understanding of the subject, but do not really apply these lessons when investing. What do you think would be a good way for someone to start incorporating behavioral aspects into their investment process? Real simple. Discretion. If you're sitting there and your investment process is discretionary in the sense that you have the TV on and you have 10 screens in front of you and you are trying to make sense of all of that information and then risk a certain percentage of your limited capital on something that's coming across the screen, Joe Kernan on CNBC yelling at you that this just happened today, you get all excited about the Snapchat IPO. This is all nonsense. This is noise. If you don't have a rigid plan that tells you, here's my portfolio, here's when I will enter, here's how much I will bet of my limited capital, and here's where I will exit with a win, and here's where I will exit with a loss. If you don't have those 5 issues thought through, prepared, lined up, and ready to execute at any given moment, you're done. And that's why the behavioral aspect is so great for trend following. Because you're putting yourself on rules, so to speak. You're giving yourself rules. The efficient market hypothesis is not accurate. The evidence is in. But what are you going to do when you say, I follow behavior? If you follow behavioral rules, there really are no behavioral rules, so to speak, coming from the, quote, behavioral community. Some brilliant work, some brilliant minds. But what I find so interesting about trend following is like the best example that you can find of behavioral economics finance in action. Cut your losses, let your winners run. It's prospect theory in action. So if you're going to bring that behavioral mindset into your world, you need a systematic plan. You have to know at every moment what you're going to do. Because if you allow that lizard brain of yours to get into action, if you allow all those human biases to play out, and they will play out, if you don't have something in advance to control your humanity, to keep your humanity in check, you're toast. The market will win. You will lose. Sunrise, sunset, like clockwork. What are some of the books that have influenced you the most over the years? Great question. Ayn Rand, The Fountainhead, right up there at the top. Michael Mauboussin's More Than You Know. Jack Schwager's The Market Wizards. Against the Gods, The Remarkable Story of Risk by Peter Bernstein. Extraordinary Popular Delusions and the Madness of Crowds. Reminiscences of a Stock Operator. Full House by Stephen Jay Gould. Blue Ocean Strategy, a great business read, completely applicable to anybody in the markets. Also, Seth Godin's Linchpin. And lastly, a relatively new work, Peak by Anders Ericsson, all about deliberate practice. I think that grouping of books is a fantastic start for anyone. Markets, finance, economics, business, entrepreneurship, I don't care. Those are a great start. Number 7, what is the best advice you have ever received? The best advice that I've ever received, not directly, is something that came from Ed Seykota. Even though I became friends with Ed Seykota, have learned from Ed Seykota, and I'm paraphrasing a little here, but he said, everybody gets what they want. It's very reflexive. So for example, if your CFA candidates want to be skeptical of trend following, they will get what they want. If somebody continually loses money in the markets, they're getting exactly what they want, which could be very well losing. You see, if you want to fix the losing, there's ways to do that. If you want to fix your skepticism of trend following, there's ways to do that. People need to get outside of themselves. And if they can't, you can look at almost anybody and they're getting what they want. Is somebody sitting across from me possibly obese? They're getting what they want. Absolutely, they're getting what they want. If somebody is sitting at a desk job, not achieving what they want, and they stay at that desk job, they're getting exactly what they want. You want to change yourself to what you want to be. That's the bottom line. People can study rote memorization, formulas. They can memorize tests. They can pass all the exams. But if they don't know themselves and they're weak-minded, they're not going to get what they want. They're going to fail. That's life. That will always be life. This is a show of interviews interviewing me, and I want to play an excerpt from another interview that I recently completed, this one with Bloomberg. The story of the real-life trading places, how turtle traders learn to make money. Tracy Alloway, Joe Wiesenthal at Bloomberg. Their show is called Odd Lots. You can easily find this online. In fact, I implore you to go find the full episode online. They did a really nice job. Go check it out. Here's an excerpt from my interview on Tracy and Joe's show at Bloomberg.
Is the trading places analogy the right way to think of it?
There is conflicting stories, but the best of my research over the last 20 years is that Rich Dennis and Bill Eckhart went to that movie. And essentially, Rich said to Bill, I can do that. I can take them off the street. I can train them. And, Bill Eckhart said, no, impossible. And I don't think there was a monetary bet like in the movie, but they placed ads in the Barron's Wall Street Journal. Thousands of people responded. I mean, at this time, the biggest trading names on Wall Street were George Soros and Rich Dennis. So even though Rich Dennis has not been in the public eye for a long time, he was huge at this point in time, having made several $100 million by the age of 37 in 1982, 1983. So essentially, really, really successful. They took thousands of resumes. They hired about 20 people, gave them a couple weeks training, spread out over 2 years, and really pretty much out of the gate, using what they would call a trend-following system, these students, ranging from like 19 to late 30s, all started to make money. Huge money. A lot of money. In fact, millions of dollars.
And one of those students was Jerry Parker, an accountant at a CPA firm.
I answered an ad in the Wall Street Journal in the fall of 1983. Richard Dennis, a famous commodities trader in Chicago, wanted to hire people, train them, give them money, and teach them how to trade and put them on their own. And I sort of knew that sounded like really good, since I was an accountant in a CPA firm, not having fun, wanting to get out of that as quickly as possible. Leaving a small town in Virginia, going to Chicago, I mean, it couldn't be any better. I had heard of Richard Dennis through a Business Week article, I believe it was called The Barefoot Trader. Rich liked to trade with no shoes on, I guess. So I knew it was legitimate and that this was a great idea and something that I would learn things that I would only learn by having a great mentor and a real famous, smart person teach me, and not something I'm going to learn in school or anything like that. So I knew I was on the right track, and then it just became, how do I get this job?
Before we get to the training aspect, the recruiting part, you said they put ads in Barron's just asking people who, if they wanted to become a trader. What were they looking for? Any qualities in those people? Were there any sort of initial screens that sort of helped them, find people more predisposed to success?
They did give a test, so to speak. They had true-false questions and essay questions. The true-false questions were essentially the types of questions that you might ask a quantitative, systematic trader, because that's what they were doing. So they wanted to get people that could think in terms of odds, chances, and people that could think in terms of risk. Perhaps that was in their background. There was some, a Dungeons and Dragons author. There were some blackjack players. There was a CPA. So they did go for people that were fairly grounded in numbers, because at the end of the day, what they taught and what they learned, what they applied, and to this day you can still see, was all grounded in something that, frankly, again, to this day, Wall Street doesn't really pay attention to, which is this quantitative, systematic, trend-following trading. This, forget the earnings reports, forget the crop reports. Who cares about the fundamentals? We're literally just trading the price of the instrument at hand.
Everyone who applied, I think 1,000 people in 1983, everyone was sent a test, a true-false test. The second part of the test was maybe 5 discussion questions that you had to answer in one sentence. That was a recurring theme whenever we were asked certain questions. It had to be responses in one sentence. But so 100 true-false, psychological type questions, trading questions, sort of getting at the root. How do you think about life? What do you think about the markets? So I carried this test around with me for a few weeks to the audits, and I was trying to delay as much as possible sending this back in, and then I finally sent it in, and I got a call to come to Chicago for an interview.
Walk us through what the training was like. So 2 weeks of this trend-following training. As you point out, it must have been pretty numbers-based. It must have been pretty rigid. It can't have been that complicated if it took place within 14 days or so.
Yeah, you were looking to give people basic rules that would tell them when to enter a market. For example, a moving average, crossover, a breakout. You were looking to give people that same rule could be used for your exit. Then get a little more complicated on position sizing. So, for example, if these students, and they did have limited capital, how much should they bet of their limited capital? Now, at the time, they were trading the most liquid futures markets. That was probably less than 20 or so. Today, that universe is much wider, and that was essentially what they were really learning. And it was, frankly, not as much about the rules. They were important, but it was that discipline to follow the rules. Because here you have Rich Dennis who says, here you go, 2 weeks of training, the rules are straightforward. Now I'm going to give you my money. You have to follow these rules or you're out.
We have a 2-week course, 3-week course, and we're taught everything we need to know about how to trade. It's right around Christmas time, so the final exam question was delivered at the Christmas party verbally to all of us, and that is something like, if you get a sell signal in soybeans, but you hear through the grapevine that Richard Dennis is long, what are you going to do? And of course, that obvious answer is we're going to follow the rules and sell those soybeans. So a lot of people describe the essence of what Rich and Bill were trying to get out of this was, can trading be taught? Rich said maybe yes, Bill said maybe no. But I think in the final analysis, it wasn't, can it be taught? Of course, you can teach anyone the rules. These were not complicated rules, but really it is, how hard is it to follow those rules all the time, regardless of how bad it gets?
So, Michael, when you say they learned the exact right amount to bet, are you talking about something like the Kelly criterion?
They would not have got that in depth. It was something more robust and more basic. But yeah, essentially, I tell people, look, if you have $1 million capital and you're going to go place a bet or place a trade, how much are you going to bet on each trade? Are you going to bet 10% on each trade? 5%? 20%? I mean, look, if you get 10 losers in a row and you're betting 10% per, you're toast, because you're going to get a string of 10 losers, especially with the type of methodology that Rich Dennis and Bill Eckhart taught their students. So the idea was to bet small, and to, when you got a breakout or an entry, to take it and ride that trend as far as it could go. And within their risk management, within their position sizing, they would pyramid. So the idea would be, at the end of the day, if you had a huge move in coffee in XYZ year, you would just make a fortune from coffee. Now, your other trades might be break-evens, small losers, etc. But the idea was that each year you were going to try and capitalize on an unforeseen trend in a big liquid market, something that no one could predict. And to this day, that's what they do.
Did you say they would pyramid? What does that mean?
Well, for example, let's say you get an entry signal. I used coffee. Let's say you get an entry signal into coffee. You take a position in coffee. If it starts to go your way, the rigid mathematics behind Eckhart's reasoning was that you would put on more. And so you might start with an initial small bet, but if that trend kept going your way, you would risk more up to a limit. So they had certain risk management limits But that was the idea, that you would pyramid in, you would increase your position if the trend that you entered kept going your way.
Got it. So talk to us a little bit about the initial results. You said they did really well. What do we know specifically about how much money was allocated to these amateur traders and how quickly and how much returns they started seeing?
Well, I went back and I was able to find their actual track records while they were under Dennis's management. Their account size ranged from, a few $100,000 to $1 million to several million. And frankly, even to this day, some of them don't understand how that money was allocated to them. And there's not necessarily any rhyme or reason as to how some of those allocations were made. But in terms of performance, I mean, they were blowing the doors off. This wasn't just 12% a year. They were trying to make 50% a year, 100% a year. This was shooting for make a lot of money.
Richard Dennis believed so strongly in this experiment that he gave the traders some of his own money. Well, a significant sum of his own money to trade with, right?
Yeah, absolutely. They didn't have money. I mean, the deal was they were going to sign a contract. They were going to be quiet, non-disclosures, and they were going to trade his capital with his rules, and they were going to get a percentage of the cut. I think it was 10, 15, 20%, something in that neighborhood. And so a lot of them made several $1 million working for Rich Dennis during this almost 4-year time window. And they all went out on their own around 1988, somewhere in that neighborhood. It was the great story, frankly, of nurture trumping nature. We talk about the Trading Places movie, but that's the great lesson for everybody here, is that this isn't an innate talent that you're born with. You can be taught. You can be taught to be a great trader. And this story is so timeless for that very fact alone.
Michael, we mentioned this in the intro, but on that note, these traders, these amateur traders, were known as the turtle traders, right? And Richard Dennis came up with that name. How did he actually come up with that?
There's differing stories about that name from differing turtles, frankly. The one that's most popular is that, and I think this is the one that Rich Dennis signs off on, is that he was in Singapore and was at a turtle breeding farm and made the off-the-cuff comment that I'm going to grow traders like they're growing turtles here in Singapore. Now, I also heard from one turtle that he was very fond of the musical group, the Turtles. So there's differing thoughts there.
So you mentioned it went from 1984 to 1988, 4 years. How and why did it end? And then what did the Turtles do afterwards?
I don't think, in hindsight, Rich Dennis and Bill Eckhart ever would have ended it. But at the time, it's a long time ago, perhaps they didn't see how great of a story it was going to be. So what happened was it ended, and Rich Dennis kind of closed down, retired. Look, he'd made a fortune. And most of the turtles went ahead and registered with the government as fund managers. I
went to Wall Street and walked around and tried to raise money. I remember walking around and, payphones back then, that's, many, many years ago. And I remember calling up the head of managed futures at Merrill Lynch, and I said, got his assistant, and she said, who are you? I said, Jerry Parker, and I'd like to meet with the head of the managed futures department. And she goes, no, he's very busy. And I said, well, please tell him that I'm a turtle. And so she gets back on the phone and she's laughing, and she's like, yeah, come on up. So one of the great things that we had coming out of those 4.5 years was a legitimate track record that we could, 100%, maybe it's kind of crazy, 200% a year. But, when we started raising money, it was helpful to at least have that background and that track record. And then you start toning it down, trying to make, 15 or 20%. And then you're out on your own in Richmond, Virginia. Rich is not my backstop anymore, so I'm maybe exercising a little more discretion, more of my style, and so you're like, wow, this is very interesting to leave that cocoon for the scary world.
And frankly, what's so great about this story is not only was it just the turtles, but the turtles inspired fund managers that are massive today, that are managing multi-billion-dollar accounts. This story wasn't just something that kind of died. Not only did the turtles make all the money and make a lot of money when they left to go trade for their own accounts and trade for other customer accounts, but so many other trend-following type traders, the strategy that they were using, they inspired traders all around the world that today run multi-billion-dollar accounts.
Michael, was every single turtle trader successful? Was there not a single one out of the 23 that didn't make it?
So it's an interesting question. I believe one or two of them lasted for a year. And after the program ended, I would say over 90% of them went ahead and traded for clients, opened up a fund management firm, and frankly were successful. I'm able to find, having researched this subject just about more than anybody and knowing the cast of characters, as you might imagine, the human nature is such that you're always going to end up with a few oddballs. And, there was a few personality oddballs inside the experiment, but the results are overwhelming. You can actually, and some people might say, hey, these are just the lucky survivors. But I would say, hey, look at the few that didn't make it and find out what they did wrong. And it's pretty easy to look at the few that didn't make it and see what they did wrong. So it's just one of those great stories.
So often when there's a popular strategy, the fear is that more and more people start to do the strategy and then the strategy doesn't work anymore. And there's sort of a common challenge in markets, trades that eventually all the money is gone from them. How does that play into this story? If these turtles all were following the same rules and then they inspired all these managers and then they had their own funds and presumably traders working for those funds learned the strategies, did the strategies have to evolve or did they just fundamentally continue to work? How did the sort of popularity of them affect the performance?
Well, trend following has fundamentally continue to work. My guess is about 0.25% of all investing assets today are in trend following strategies. The vast majority of people believe in the efficient market hypothesis. They believe in indexing, buy and hold, all of these things that when the black swan swims in, like October of 2008, the vast majority of people get crushed. So this is a very, counterintuitive, alternate type strategy, and it has not slowed down at all. Now, it can be difficult for people to perhaps stick with it because you are taking risk. You can possibly lose, depending on what leverage you're employing, you could lose, 20, 30, 40% of your capital, perhaps even more. But then again, Warren Buffett's taken his share of 50% drawdowns. It's just one of these great under-the-radar type strategies. And I think what's really cool, I mentioned October of 2008, it's the one strategy that made a fortune in that month of October 2008. So, when Nassim Taleb talks about the black swans, this is truly a great black swan strategy at its foundation, at its core.
But if I could play devil's advocate for a second, if the strategy is so simple that it can be taught in 2 weeks to novice traders, then why isn't everyone doing this?
It's a good question, but that's why Daniel Kahneman won the Nobel Prize. Right? That's why Amos Tversky, if he would have been alive, would have got it as well. That's why behavioral finance exists. People don't want to look outside of the mainstream, and the mainstream is the vast majority of investing assets are in passive index funds, waiting for something bad to happen. So it's just it's an alternate, counterintuitive strategy that most people aren't willing to accept. Especially, when the stock market's at all-time highs, people say, "Hey, this looks great. I don't have to worry about anything."
Mainly, I believe that the trend following that works longer term than it used to be is very unappealing. And there's some inherent characteristics of trend following that make it something that is not something people really want to do. 40% winning trades, who in the right mind? Everyone knows you got to at least have a 50% win rate. No, not really. 40% is about as good as you're going to do. take small losses all the time. So you're always, getting in and getting out with a small loss. And then, of course, it goes right back to the high. You have to buy it again. So it's a very painful way of trading. Small profits turn into losses. You're just following that system. You can't say, I want to book a profit here. Nope. You have to wait for that moving average or breakout to be hit. Big profits turn into small profits. The drawdowns are horrible. It's usually, I think, for a lot of smart people, the first place to start this trend following. Now we certainly should be able to improve upon it with little bells and whistles here and there. And I think that's where people get in trouble, because I've never tried to really improve upon it. I've just accepted my fate that, yes, if you're going to have a systematic approach that continues to work, it's in the public domain, they write PhDs, write papers about it, about how it continues to work, then it seems only fair that it should produce a fair amount of pain and suffering and bad periods. And that sort of, I think, keeps too many people away from it.
Do you think the turtle experiment would work again in today's markets? And Joe kind of hinted at this, but in markets that are, full of passive investors, full of high frequency traders, momentum trading, all of that, will the turtle rules and the turtle experiment still uphold?
Well, that was what they were taught. There's two types of momentum. There's time series momentum. There's cross-sectional momentum. And they were taught time series momentum strategies, i.e. trend following. Would it continue to work? I could sit here and I won't bore you, but I could rattle off the names of the professional fund managers working today. So no, trend following is never going to go away as long as we have human nature.
Does trend following work across all asset classes? So you mentioned that the turtles trade liquid futures, but do the same principles apply to equities and currencies and fixed income assets?
Absolutely. They, back in the day, the turtles, it was commodity markets, your coffee, your gold, your currencies. That has not changed today. I think the only thing that's changed is perhaps more individual equities have been added to trend following portfolios. But if you really think about it, since you're just trading price action here, there's no fundamentals involved. It's really hard to make the jump that the action of markets would be different when you look across instruments, because look, these instruments are just representation of people. And, so it's all humans making these decisions. So really, if you just think about it that way, there really shouldn't be an expectation that it should behave differently. As long as people are involved in markets, there's going to be extreme moves. And as long as there's extreme moves, strategies like trend following will continue to perform well.
I want to get back to the trading places analogy, because the way the turtle trading experiment was structured, you put these ads in newspapers and these people responded to them. So I'm wondering if in some respect, the turtle traders kind of self-selected themselves. I mean, they were all reading Barron's and the Wall Street Journal anyway, so they clearly had some sort of interest in markets, and they were probably reasonably smart people. So when we look at this experiment and the successful outcome, how much can we actually read into that outcome? Like, could you apply this to anyone, just the man off the street? In trading places, it was a homeless Eddie Murphy. Would that work?
Well, I don't think in any endeavor in life you can take somebody off the street that has no motivation, no drive, no desire for excellence. I don't care whether it's sports or whatever the job is. I mean, you've got to have some internal combustion going on there. Otherwise, it's going to fail. So I think if you just take, I'm going to use not a bad word, but if you take some dolt off the street who doesn't really care and is not really interested, they're going to fail, and they should fail.
You mentioned that it's still a very tiny amount of assets today are in trend following strategies. You're obviously sort of deep in the weeds on this whole space. Do you see a lot of people, or do you see interest in these strategies still growing rapidly today? Like, especially as people sort of rediscover this story, find resources on the internet, has interest picked up?
Well, yeah, absolutely. And I wouldn't say there's been an explosion of assets, but it's a steady growth of assets under management in trend following strategies. The reason for that is most pension firms today understand that if they're long only stocks, they're exposed. There's a certain risk exposure there. So if they can add into their portfolio, this is like Harry Markowitz 101, if you can add into your portfolio something that's not correlated, spinning off a different risk return profile, all of a sudden you end up with a little bit more performance and a little less risk. So it makes a lot of sense for everyone for that reason. And you can find these days, there's been quite a few managers that have gone ahead and put together public mutual funds, public ETFs. So there's different ways for people to participate. Of course, they can go do it on their own as well, too.
Did Bill Eckert pay Richard Dennis $1?
I never heard anything like that. I don't know if that was their bet. Maybe if you get Rich Dennis on the phone, he can answer for you. I mean, it's kind of hard to believe. I kind of hear that in both of you, like, oh my God, this story. It's you got the book in front of you. It's factual, but it's still hard to believe, isn't it?
Yeah, I think the part that's hard to believe is not the story itself. Like, I'm not surprised the period from 1984 to 1988, that I don't find hard to believe. And I also don't really find it hard to believe that a lot of those traders went on to have a lot of success and influence. I think the part that feels counterintuitive to me is the idea that there's this strategy that exists out there. The way you say it kind of sounds like picking up free money, that it works, that it hasn't been diminished by the fact that you wrote this book and that all of that this incident is the stuff of Wall Street legend, that despite all this attention, that the strategy still fundamentally works without a whole lot of innovation. I think that's the part that, to me, most intensely flies in the face of how we talk about finance. That it shouldn't be, not that beating the market is impossible, but that one strategy or one principle can beat the market on an enduring basis for so long is the part that is still hard to believe. But I mean, I believe it. It's just the part that makes me uncomfortable. Does that make sense?
Well, I think it gets back to, I bring up Daniel Kahneman again. It's his work. If you were to find a strategy that exemplified prospect theory and a lot of his behavioral work and the many other great minds that have come after him diving into behavioral finance, that psychological element, look, you can have the rules. Rich Dennis used to say he could publish the rules in a paper, but it doesn't make a difference if people aren't going to do it. So we could sit here and talk about rules all day long. And yes, the rules are clever and they're interesting. But if you, anybody, me, you, whoever's listening, if you don't understand those natural biases that you have built into you, and you have not put it in your mind that you're going to stick to these rules no matter what, then it shouldn't really be a surprise that, frankly, a lot of people don't want to do it. I mean, like, that's the whole reason why, Michael Lewis's new book that's out right now, it's the foundation. People are just people, and we're all a little bit crazy, and we really, we want to get rich quick, and we want to trust people on Wall Street telling us about the latest, high frequency this or the latest crop report. And so, it's a quantitative strategy that perhaps doesn't make money for 2 years, and then all of a sudden makes a fortune in October of 2008, or has an up and down period for a stretch. People aren't interested in that. At least the uninitiated are not interested in that. Again, go check out the full interview at Bloomberg. It's called Odd Lots. Joe Wiesenthal, Tracy Alloway. The title of the story of the real-life trading places, how the turtle traders learn to make money. Again, a fun podcast to do. And for those of you out there that listen to my show regularly, you will recognize that other voice in that excerpt that I just played was Jerry Parker. And if you want to know more about how Jerry Parker thinks in the nitty-gritty details, there's at least 3 episodes on my podcast where Jerry appears. Go check those out. There is also a special interview in my audio version of The Complete Turtle Trader, the only place that I put that interview with Jerry Parker. I hope you enjoyed both of these interviews today, and I hope as my new trend following edition, this massive, epic, 220,000 word plus beast, as it hits the streets in late April 2017. Hopefully, there will be a few more interviews to get a few more insights out of me about what is a subject, trend following, that every investor needs to know about beyond a shadow of a doubt. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.